Thank you, Alan.
Thank you. Thank you very much, everybody, for coming. So first of all, Bill, superficially, investment in real estate seems like a simple business of two numbers. You have rents and cap rates. But then we do know that fortunes are regularly lost and made in real estate. Why do you think that is?
Because the key word is superficial. I don't think it is a superficial business. I don't think it's rocket science, but it's about doing many tasks, none individually complicated well. But to answer your question, fortunes are won and lost, period, in a lot of industries. And they're won and lost in financial service-related industries, and real estate is indirectly a financial service because people forget there's a business cycle. And they're greedy when they should be fearful, and they're fearful when they should be greedy. So I think it's the animal spirits which causes people not to stop when markets get overheated. They're one more deal, one more deal. What compounds it in real estate, and this is the important point, is that until recently it was a highly leveraged asset class. 3 to 1, 4 to 1. Banks had excess balance sheet capacity because all the good corporate borrowers went to the bond market, and they lent, and it was a low barrier to entry business for second generation immigrants, people. You didn't need a university education. So I think that the leverage in the system amplifies the cycles, but I don't think it's superficial. And it's cap rate and the yield, the rents and the yields. I mean, you need to unpack each of those numbers. Which are they heading directionally? Where are interest rates going? Where are tax rates going? So
it's the importance of the analysis that matters.
Yes, you can overthink it, but you can underthink it.
Yeah. I was at a conference today, and someone said something along the lines of that the market will bring you down, but the banks will kill you. And,
well, that leverage is the double-edged sword.
With everything going around us now, with the European crisis, how should long-term investors think about real estate, such an illiquid asset class, against this macroeconomic backdrop of what's going on in Europe?
There's no one Europe. There really isn't a crisis in Germany, except how much they're going to have to subsidize the countries that actually have the crisis. I mean, in the 90s, Germany was described as the sick man of Europe. It has extremely low unemployment, and it exports more than nearly every country in absolute terms, despite India, the US, Brazil, China all having populations much greater. I think the UK is in an austere time, but I don't think that the foundations are in crisis, and the Nordic countries are thriving. I think that the crisis is in the peripheral economies where this cycle has amplified their weak spots. So in general, they had social democratic aspirations in their spending, but they didn't have the economic growth generators to afford that. Italy, a lovely place to visit. If there are Italians here, I mean no disrespect, but a very challenging economy. Spain got wildly imbalanced in construction, in housing construction. Ireland guaranteed a banking system which was integral multiples of its GDP. So each of these countries had multiple Achilles heels, which the recession and the banking crisis amplified. And there's a currency problem because really the Deutschmark went in cheap and everything else went in dear, and Germany has benefited. So there are problems, but the countries will have to tighten their belts and get their way out of them. I'm fundraising, and I tell investors Europe consists of 750 million people with 48 countries, and its needs are not going to disappear, but it has to, it has to take the medicine of austerity for a while, I think, before sunny skies reappear. But you have to segregate it between north, south, east, and east and west. I mean,
would you see, I would say, interesting markets, or would you still consider some of the peripheral investments? When you speak to your investors, does those economies, is something you're saying we may be able to find opportunities there, or is it more of a...
Ireland is very small, and I don't know if the gentleman from Frank Warwick was there, but we had the opportunity with F&C to buy a fantastic shopping center in Dublin at a 9% yield, anchored by Marks and Spencer's, Boots, View Cinemas at a 9% yield. But we sat around and we said, okay, if we're going to pay 300 million euros for it, we need to sell it for 360 to 370. Who's going to write that size of check? These markets are small. Portugal is small. Ireland is small. It's okay for a private investor.
Yeah.
But I'm very worried where the only exit is the local buyer. Spain's a real place. If you have the stomach for Italy, that's fine. Greece is not a relevant market. I think the more interesting markets are Poland and Czech and the more successful convergent states into the EU. But those are already mainstream markets.
Absolutely, I agree. Do you see any interesting niches or sub-markets that would provide, that are currently either undervalued or would provide opportunities for growth, specific that you like at the moment right now?
Well, I mean, the central London residential story is a phenomenal one. Before the recession, builders would build in London for a 15% pre-tax margin, which is 10% after tax. So if the costs were 100 million sterling to build something, the profit was 10 million. And in development, a lot of things have to go right. But land prices came down, building prices came down after the Olympics, but because it's a global city with restricted restricted supply, capital values are above their pre-crisis levels. So the margins on these deals are phenomenal. And we've made this is not an advertisement, this is a statement of fact. We are building or have built 1,600 units, which if they're 20,000 delivered, that's 8% of the market. So we're active.
Yeah.
That's a very exciting niche. Everything else is case by case. There's no macro theme that I could see at the moment. Except the deleveraging story. There's too much debt, so you have to pay back yesterday's debt with today's equity.
We're open for questions. Just remember, raise your hand.
We're happy to take them.
No, I'm asking about niches because quite a few investors are interested in things like student housing or senior living or very small niches, which sometimes have attractiveness.
We've shied away from those for one reason. We're not very good at them. They tend to be the intersection of private equity and real estate. You've got to get the right management team because there aren't many replacement operators. So we tend to like the more standard asset classes. But people have done very well in housing, in student housing. I mean, the demographics on senior living are compelling, but the management companies and their balance sheets have been very troubling, and the government's your partner. 80%, 70% of the money's from the local authority. Which way are those budgets going?
Absolutely. The U.S. market has gone from being everybody's favorite punch bag, really, you mentioned earlier, seeing tremendous decline in values, to being suddenly everybody's dearest asset class, and seems like there's no roof to where the U.S. market is going. How should we think about fundamental values in a market that is just going higher and higher and higher? I guess maybe Central London is also a little bit similar in the sense of rising and rising, and what's the fundamentals behind it?
I don't know if the U.S. economy is recovering. Corporates are spending, so in the major cities there is absorption. People are beginning to spend again, so some of the shopping centers are doing well. Until recently, because of the difficulty of getting a mortgage, the strongest sector was rental housing, which is different. The UK does not have the garden apartment concept. 300 units around a golf course or a swimming pool in a Sunbelt city. So the proportion of renters in America is much greater than here in the UK, and that's been a dynamic asset class. So there have been fundamentals that have been driving it. The question now is the pricing ahead of the fundamentals? So will rents grow to justify low cap rates. And you have to look at it city by city, case by case. Liquidity is back in the market. The banks recapitalize themselves. They're lending. And there is a lot of equity, institutional, high net worth, foreign, looking for a home.
Yeah.
So it's getting hot. Again, you can't generalize about the U.S. Beaumont, Texas is very different than Manhattan. And there really are about 6 or 7 cities you would want to own an office building in.
Yeah. I wonder for say, great interest for the people in the room, also a place that in some views has disconnected price from fundamentals might be London areas and central London. Do you have any views on that? Where has it really disconnected the price from fundamentals?
Well, at the very prime level, if you're a well-leased office building in the West End or the city, the best will go for 4.5% to 5%. Because interest rates are below equity cap rates, it's not as crazy as it sounds, but I think that will produce a mid-single digit return. Those are investments that are stores of values, not creators of values. So that's flight capital, that's glorified savings account, that's a sovereign wealth fund that wants to diversify and it wants to put in a stable asset and a stable currency. That's at the very top end of the market, and that's where the flow of funds has been. But I think pricing on anything that has an imperfection is not out of whack at all. So the risk-off trade is very expensive, but if there's a short lease, if there's deferred capex, if it's a good building on an okay street or a not so good building on a great street, the institutional buyers aren't buying at the moment. I think they'll come back, but they're not buying.
A bit of a personal question. Does being American and possibly being a Jew impact your ability to do business in Europe? Your 13 years or 12 years in Europe?
Well, I remember when I was in Spain and the host ordered dinner and it was Iberica ham to start and shellfish afterwards. And I realized that the Jews left Spain not because of persecution, because they were starving. But actually, I had never experienced any anti-Semitism in Europe at all, or nothing that registers. So no. And in terms of being an American, also no. I think that I'm the only American in the office. We have been deliberately positioning ourselves as a European firm as opposed to an American transplant, and I think that has worked.
So personnel-wise, the people who work with you would be from the countries where you invest as well?
Yes. So we have German speakers, Italian speakers, French speakers, Spanish speakers. We have Irish, we have Scottish, we have Welsh. It's.
Do you invest in Wales as well?
We have from time to time.
Great. The investing world is rapidly becoming more institutionalized and more specialized. Is that the right trend, or do you see value in a more flexible, broader approach?
It's a difficult question. The world is specialized, and it depends on your objective. If you're a private investor or a private property company that doesn't have to access external equity in a systematic way other than friends and family, you can do whatever you want. The minute you go to a pension fund or a sovereign wealth fund or the public markets, in a normal market, the question is, what is your unique selling proposition? What are you good at? And you have to be good at something, and you have to be consistent and be good at something. The challenge, of course, is that niche may go away, or that may be out of favor. But the trend, rightly or wrongly, is, what are you good at, and give it to me in 2 sentences. It's just the way the money is at the moment.
Again, maybe I don't know if it plays into the recent acquisition that was mentioned before in your merger. Do you think that is part of that, part of having a more broader appeal?
Well, the trend that we observe, we fund ourselves in the pension fund market. So we raise closed-end funds, private equity funds, and it's sovereign wealth funds, it's American pension funds, corporate, local authorities. And what we found was real estate is local, but capital is global. And you need a serious human infrastructure to cover investors from Seoul, to Santiago. And that is expensive. And there is a trend among large limited partners, the Adias of the world, the CalPERS of the world, to say, we want to shrink the number of managers, and we want those managers to be able to execute multiple strategies for us. So Ares has private equity and a lot of credit, public and private debt, but they were missing real estate. And we felt we were better served aligning ourselves with somebody who had deep institutional relationships across the globe. We just couldn't cover it anymore. And there is a rotation of investors, and you have to keep digging for new money.
Yeah. Well, I guess we see, yeah, go ahead.
Can you talk a bit more about the residential market in central London and where you think yields are going?
Well, I can't comment on yields because what we develop, well, I'll comment on yields, but what we build is for sale. A portion of the people who buy it turn out and rent it. So often if there's a 100-unit scheme, you pre-sell 20, 30 units to a buy-to-let person to de-risk the project. You know, those yields in good neighborhoods are net 4% plus or minus. So I think that's a bet on capital growth, but rents are going to rise in London because there's not enough housing being built. You know, London is adding 1 million people this decade. It's going to add 1 million people next decade. The mayor's plan for London said that they needed 30,000 new units a year to accommodate population and household formation. That's now being revised. And really, the city needs 50,000 private sector, not affordable, private sector homes. The industry is struggling to deliver 20 to 25. These are facts. This is not a sales pitch. These are facts. And so there is a chronic and compounding gap at all price points, particularly at the £400 to £500 a foot, where it would take a year's earnings to get a down payment. So we don't see an abatement in the demand if London remains what it is. And as anyone who's active in this area knows, you can set all the targets you want at government level. Planning's at the very local level. And to aggregate a site of sufficient size and get planning from councillors who want to preserve the village-like feel of their local authority is very difficult. So the supply response is not keeping up with the demand. So more people are being forced into private rental housing, and yields will go up. Rents will go up.
So why do you choose not to maintain a certain part of the developers?
Because for us at 4%, it's just not attractive. I mean, we're not hot money, but we're not really patient money. We're modestly impatient money. So we want to be out of a deal in 5 years. Earlier is better. And we wouldn't get enough rental growth to get us to a satisfactory return. But, you know, if you're patient, fortunes have been made on rental housing.
Good.
It's probably more information than you wanted.
During the course of your career, you worked for a diversified alternative asset manager, Apollo. You then spun off your own entrepreneurial startup. You received funding, institutional funding from NAB, and you were recently bought by Ares. What are the advantages of different models? We spoke a bit about it a little bit. And can you maybe talk about the challenges of integrating an entrepreneurial culture with a more institutional framework?
It's always been one firm. We were part of the large private equity firm called Apollo. They owned a minority stake. They owned 20%. We became independent in 2006 for strategic reasons. And we brought in NAB to give us growth capital because for each fund that we raised, we had to put in $15 million. So when you're a private partnership, there's a limit to how many $15 million times you can
Yeah.
do that. So they put in capital in the company to help us grow, but they had no control. So really, since 1993 till now, it's been 5 people running the firm with the same culture. The Aries decision was a once-in-a-lifetime, once-in-a-career decision that we would sacrifice some of our independence for what we thought was better for the next generation of people. It hasn't closed yet. I don't know what it will be like. I mean, when the Aries approached us about the deal, you know, among the partnership people said, let's put well, if they're interested, let's do an auction.
Yeah.
And some of us said, no, this is not the type of business you auction. This is a people business.
Yeah.
We knew the Aries people because they had spun out of Apollo in 2000. So we were cousins from the same family. It's all about culture. You can have an entrepreneurial culture and a big organization. You can have a small organization and be brain dead as well. But it is the issue. I don't have the answer yet. I'm hoping we will get, you know, the best of both worlds, but I'm sure there will be more committees, there will be more forms. You know.
What does next generation mean when you say for the next generation?
Our founder is 74, our CEO is 62, our CFO is 60. There are people, I'm 49, so I'm sort of in between, but there are a number of very, very good people in their mid-30s who are now hitting their stride. And we thought that they're the future of the company, but their opportunities would be greater aligned with a larger firm.
Okay, understood. Because succession has been a problem for many large private equity firms. And
Yes.
We sit around with septuagenarians, founders all around, and so it's always a big question. What do you do with that?
It's a big question. It is good to avoid a star system.
You are both an accomplished investor and the leader of an investment firm. What are the biggest challenges you face when wearing these two hats of both manager and investor?
Well, I think the problem you face being an investor is the 2006 moment when your head tells you to stop, but your stomach tells you to go. I mean, I don't know who gets that right, but that is the key. If things are getting expensive, step back. But after a while, you know what works for you and you know it doesn't. We're not good at hotels, you know. So you know. The people side is much more complicated. I mean, the cultures that work the best are meritocracies, are transparent, where people have unanimity of goals, and where people are self-starters but team players, and that's the balance.
Yeah.
The people who do well coming up are those who know not to bother senior management with little stuff, but know when the risk that they're putting on is something they need blessings for. And in general, if there's one lesson is with personnel issues, deal with them early. Okay, if somebody is not working out, if somebody's unhappy, do not let it fester. It will only get worse. It has to be addressed. And you want to be firm in the decision, and if it's an unpleasant decision, you want to be compassionate in the execution. But don't stick with losing personnel too long because it demoralizes everybody else.